Last month, I logged into my credit card account to pay my bill. Before I could do anything else, a pop-up appeared. Friendly, casual, almost cheerful. Update your annual income to help us serve you better. There was a little form with my old income pre-filled and an empty box inviting me to type in my current number. Serve me better. That's how they framed it. Like they were doing me a favor. Like this was customer service. I closed the pop-up without updating anything, because I know exactly why they're asking, and it has absolutely nothing to do with serving me better. Here's what most people don't understand about that pop-up and about every income question a bank has ever asked you. When you tell a bank your income, you're not completing a routine form. You're handing them ammunition. You're giving them a data point they will feed into algorithms that make decisions about your financial life. Decisions designed to benefit them, not you. Every time you update that income field, calculations begin. Your profile gets adjusted. Your categorization shifts in ways you'll never see but will absolutely feel. And the part that should genuinely bother you? In most situations, you're not required to tell them. They just made it feel like you are. My name is Andy, and this is Andy Explains Money. Let me start with the thing that's going to irritate you the most. Banks are not required to ask for your income in the majority of situations where they ask for it. No federal law mandates that your credit card company know your salary. There's no regulation requiring your bank to have your updated income on file after your account is already open. They ask because they want to know. They ask because knowing helps them make more money from you. This distinction between required and requested matters enormously. When something is legally required, you have no choice. When something is merely requested, you have every choice. Banks deliberately blur this line. They design forms that feel mandatory. They use language that implies obligation. They create pop-ups that look like system requirements instead of optional surveys. Because informed customers who understand the difference, make decisions that reduce bank profits. Think about the last time you applied for a credit card. The application asked for your annual income. You entered it without hesitation. Why wouldn't you? It seems like standard information. Everyone asks for it. It's just a box on a form. You filled it in the same way you filled in your address and your phone number. But here's what happened behind the scenes the moment you submitted that number. The bank's algorithm instantly categorized you. Your income didn't just determine whether you got approved. It determined what interest rate you'd pay, what credit limit you'd receive, what offers you'd see in your account portal, and how aggressively the bank would market additional products to you for the next several years. That number you entered in 3 seconds, the one you barely thought about, became the foundation of the bank's strategy for extracting maximum profit from your relationship. Let me break down exactly how they use it. Because the mechanics are precise, systematic, and designed to be invisible. Credit limits are the most obvious use. Banks use your stated income to determine how much credit to extend. Higher income generally means higher limits. On the surface, this seems reasonable. Someone earning $150,000 can theoretically handle more debt than someone earning $50,000. The bank is being responsible by calibrating the limit to your ability to repay. But here's the part they don't explain. Higher credit limits aren't always in your interest. They enable more spending. They create more opportunity for debt accumulation. And they increase the total interest you could potentially pay over time. Banks know, from decades of behavioral data, that people with higher credit limits tend to carry higher balances. A $30,000 credit limit doesn't just mean you can spend more. It means, statistically, you probably will spend more. The bank isn't giving you a generous limit as a reward for your success. They're giving you more rope. Because customers with more rope tend to generate more interest payments. The limit isn't a gift. It's a product, and the product is designed to be profitable for the bank, not beneficial for you. Interest rate determination is where income data gets used in ways that would genuinely surprise most people. You might assume that higher income leads to lower interest rates. After all, higher earners are lower-risk borrowers. The bank should reward that with better terms, right? The reality is more complicated. Banks use income data in combination with other factors to assess not just your risk level, but your price sensitivity. Someone earning $200,000 might be less likely to shop around for a better rate. Someone with substantial income might not notice, or care about, a few percentage points difference in their APR. They have bigger things to think about. They're busy. They'll probably just pay whatever rate they're offered. The algorithm knows this, and it adjusts accordingly. Research has shown that affluent customers sometimes receive worse terms than they should because banks correctly predict they won't bother negotiating or switching providers. Your high income becomes a signal, not that you deserve better treatment, but that the bank can charge you more without losing your business. This practice has a name in banking circles. It's called ability to pay pricing. The more you can afford to pay, the more they charge you. Not because you're higher risk, because they can get away with it. And the only reason they can get away with it is because you told them how much you make. Marketing and upselling are the most persistent and most visible way banks use income data against you. The moment you reveal your income, you get sorted into a marketing category. High earners receive aggressive pitches for premium credit cards with $450 to $695 annual fees. Constant offers for personal loans, investment product cross-sells, insurance packages. Every time you log into your account, you navigate an obstacle course of upsells that have been carefully calibrated to your income bracket. Banks know that someone earning $180,000 is significantly more likely to say yes to a $550 annual fee card than someone earning $60,000. They know that high earners tend to have more financial complexity, multiple accounts, investments, insurance needs, which creates opportunities to sell additional services at every touch point. Your income didn't just get you approved for a credit card. It enrolled you in a permanent marketing program designed to extract maximum revenue from your relationship with the bank. Lower-income customers face a different version of the same problem. They receive fewer premium offers, but more predatory ones. Balance transfer promotions with hidden fees. Personal loans at steep interest rates. Credit limit increases specifically designed to enable overspending. The targeting is different. The purpose is identical. Use the income data to determine the most profitable way to market to each customer. Now, here's something even more concerning that most people never think about. Income data persists. Once you tell a credit card company your income, that information doesn't disappear after your application is approved. It sits in your file. It gets used for decisions you'll never be informed about. It influences how the bank treats you during economic downturns, whether your credit limit gets cut, whether your account gets reviewed, whether you're flagged as high risk or low risk during a recession. That income figure you entered 5 years ago might still be shaping the terms of your financial life today. Banks have long memories. Your data has a very long half-life. So let me address the question you're probably asking right now. When do you actually have to disclose your income, and when is it optional? Mortgage applications require income verification. This is federally mandated. Banks must confirm your ability to repay under qualified mortgage rules. You'll provide pay stubs, tax returns, employment verification. There's no getting around this, and you wouldn't want to. No documentation mortgages are what fueled the 2008 financial crisis. This is legitimate, legally required disclosure. Auto loans typically require income disclosure, though verification standards vary by lender. Some do full verification with documentation. Others accept stated income. The necessity depends on the lender and the loan amount. Credit card applications ask for income. But here's what most people don't know. Credit card companies generally do not verify the income you report. They can't access your tax returns without your permission. They can't see your pay stubs. They don't call your employer. They're relying entirely on what you tell them. This creates a fascinating dynamic. Banks want your income data badly enough to ask for it on every application, but not badly enough to actually verify it. What does that tell you about how they're using it? If the data were truly about assessing risk and protecting you, they'd verify it. The fact that they don't suggests the data serves a different purpose entirely, a purpose that's profitable enough to collect, but not important enough to confirm. And those periodic income update requests, the pop-ups that appear when you log in, the emails asking you to review and update your information, are entirely optional. You're under no obligation to respond. The bank wants the data. They don't need it. Those pop-ups are designed to look mandatory while being completely voluntary. Let me be absolutely clear about something important. I am not suggesting you lie about your income. Providing false information on a credit application is fraud. It's illegal. Don't do it. What I am suggesting is that you think strategically about when and whether to volunteer information that will be used to make decisions about your financial life. There's a meaningful difference between lying and declining to update. When a bank asks you to update your income mid-relationship, you can close the pop-up. You can leave the field blank if possible. You can decline to provide information that isn't legally required. This isn't deception, it's privacy. And it slightly reduces the enormous information asymmetry in the bank-customer relationship. Think about that asymmetry for a moment. Banks hold massive amounts of data about you. They know your spending patterns, your payment history, your debt levels, your financial habits, what you buy, where you shop, how often you carry a balance. They use sophisticated algorithms to analyze all of this data and extract maximum value from the relationship. Meanwhile, you know almost nothing about their internal decision-making. You don't see the algorithms. You don't understand the categorization. You don't know how your income data specifically influences the interest rates you're offered, the credit limits you're given, or the products marketed to you. Refusing to volunteer additional information, especially information they're not legally entitled to, simply reduces that asymmetry slightly. It puts you on marginally more equal footing. The bank can still see your behavior. They still have substantial data about you. They just don't have the one specific number they want most, the number that makes all their other algorithms more precise and more profitable. Let me show you how this plays out with a practical example. Imagine two customers with identical credit scores, identical spending patterns, and identical payment histories. One customer regularly updates their income when prompted. Over 3 years, their reported income has increased from $70,000 to $95,000. The other customer has never updated their income since the original application. The first customer now receives aggressive marketing for premium products. Their credit limit has been increased twice without requesting it. They're seeing constant offers for high annual fee cards, personal loans, and investment products. They're being groomed, and that's the precise word the banking industry uses, for higher fee products because the algorithm sees growing income and growth opportunity. The second customer receives standard marketing. Their credit limit remains stable. They fly under the algorithmic radar because the bank has less information to work with. Their banking experience is quieter, less aggressive, and more neutral. Which customer is better served? It depends entirely on what you want. If you want maximum credit access and don't mind being perpetually marketed to, update away. If you want to be left alone, maintain stable terms, and avoid being optimized against, keep your information minimal. A friend of mine learned this the hard way. She's a contractor with variable income, sometimes earning $8,000 a month, sometimes $15,000. When she originally applied for her credit card, she reported her income conservatively, using her lowest months as the baseline. 2 years later, she received a credit limit increase offer. The bank asked her to update her income to process it. She entered her current earnings, which were substantially higher. Within 3 months, the calls started. Personal loan offers, premium card pitches, balance transfer promotions. Her mailbox filled with offers designed to encourage her to take on more debt. Her peaceful, functional banking relationship became an aggressive sales campaign, triggered entirely by that one income update. She never updated her income again. When the pop-ups appeared, she closed them immediately. Within about 6 months, her banking experience returned to normal. The algorithm stopped receiving fresh data, her profile gradually decayed toward default treatment, and the aggressive marketing faded. This illustrates something important about how bank data strategies actually work. They're optimized for fresh information. Stale data is less valuable because it's less predictive. An income reported 5 years ago doesn't trigger the same algorithmic responses as an income updated last Tuesday. Banks know this, which is exactly why they ask for updates so persistently and so frequently. Every time you provide fresh data, you reset the clock. You become a newly classified target. The algorithms wake up and start working on you again. There's another dimension to this that most people never consider: how banks use income data during economic stress. When the economy weakens, banks review their portfolios and make decisions about which customers to retain and which to shed. Credit limits get slashed, accounts get closed, interest rates get hiked. These decisions are algorithmic, and your reported income plays a role in every one of them. A customer who reported high income might see their credit limit maintained because the algorithm projects continued repayment capacity. Or, and this is the counterintuitive part, that same high income might make them a target for more aggressive terms because the bank knows they can absorb worse pricing without leaving. A customer who reported lower income might see preemptive credit limit reductions as the bank tries to reduce exposure. The algorithm treats them as higher risk during uncertain times, regardless of their actual payment behavior. The only way to partially avoid being sorted by these algorithms is to give them less data to sort with. The less the bank knows about your income, the more they have to rely on your actual behavior, payment history, utilization rates, account longevity. And behavioral data is harder to game than stated income. If you pay on time consistently, maintain low utilization, and keep accounts open for years, those signals speak louder than any number you might enter in a form. Your actions become your profile, rather than your claimed income. Now, let me give you specific, tactical recommendations for managing income disclosure going forward. Because knowing the theory is useful, but knowing exactly what to do is better. For new credit card applications, provide income information because it's functionally required for approval. But be thoughtful about what you report. If you have variable income, you don't need to report your highest earning month as your annual baseline. If your income has multiple components, salary, freelance work, side income, you're not obligated to include every source. Report accurately within these parameters, but don't volunteer more than the application specifically asks for. For income update requests on existing accounts, close them without responding. Unless you specifically want something from the bank that requires income verification, like a credit limit increase you've initiated, there is no reason to update. There is no penalty for ignoring these requests. They'll disappear and eventually reappear. You can ignore them indefinitely. Nothing happens. For credit limit increases you didn't request, decide whether you actually want the increase. If you do, providing updated income might be necessary. If you're happy with your current limit, and you should be if it covers your normal spending without pushing your utilization above 30%, decline the offer rather than providing fresh income data to enable an increase you don't need. For loan applications where income verification is legally required, provide what's required and nothing more. If they ask for tax returns, provide tax returns. If they ask for additional documentation beyond what's legally mandated, ask specifically why before you comply. Understanding the difference between required and requested documentation protects you from oversharing. When banks call asking to update your information, remember that phone calls are specifically designed to create pressure and immediacy. The representative sounds helpful. The request sounds routine. It's designed to feel like something you need to handle right now. You don't. You can simply say, "I'm not interested in updating that information at this time." The call ends. Your accounts remain open. Nothing changes. The bank just didn't get the fresh data point it wanted. The broader principle here extends beyond banking, but it's worth naming explicitly. Every institution that asks for your data is collecting it for their benefit, not yours. They may frame the request as serving you better, improving your experience, or ensuring accuracy. Those framings obscure the actual purpose, which is enabling more precise extraction of value from your relationship with them. Data minimization, providing what's required, declining what's optional, and understanding that every piece of information you share will be used, analyzed, and monetized, is a legitimate strategy for navigating institutional relationships of all kinds. Not as paranoia, as informed participation. Banks are essential institutions. They provide services you genuinely need. But they're also profit-maximizing entities that treat customer data as a resource to be optimized against. Understanding this doesn't require cynicism. It requires awareness of how the relationship actually works beneath the friendly pop-ups and the "serve you better" language. The next time that income update request appears on your screen, and it will, probably within the next few months, you'll know exactly what's happening. The bank wants fresh data for algorithms designed to optimize their profit from your relationship, not your experience, their profit. Close the pop-up. Keep your information to yourself. Let your payment history and responsible behavior speak for you. That's the data that actually matters. And unlike your stated income, they can't get it just by asking nicely. Subscribe to Andy Explains Money if you want the next breakdown. I'll see you there.